There are two types of people that lose a lot of money. The first type that lost a lot of money and never invests again. That's not right because they never reflect on their mistake. The second type is that they continue to trade and invest, but it's just trying to get in and out of market really fast and continue to lose money. Hello everyone, it's Cody A here. I'm a 7-figure stock option investor and also real estate investor who has been featured on TD Direct Investing back-to-back 2 years in a row. And I was also featured on 80+ investing focused podcasts last year alone. In this video, we're gonna talk about 3 main points. First is the purpose of investing. Second, how closely related is investing with sports? The third is I'll introduce the concept of margin of safety so that we can ensure you continue to win for the long term. Now let's get right into the first point. What's the purpose of investing? When you invest, you want to win because winning feels really good. But actually, experts said that investing is a losing game. What does that really mean? According to Howard Stanley Marks, who managed $2.2 billion under the Oak Tree Capital Management, mentioned 3 points why investing and sports are closely related. First point is, someone wins and someone loses in investing, just like sports. Second point is, when you win in sports, you win a point. When you make returns in investing, you also means that you win. And the third point is that in investing and in sports, there's always skills and efforts involved, but another big chunk of that is due to luck. Imagine you're the top player for a tennis game. Let's use Roger Federer for example. If he wants to win the game, he has to consistently hit winning balls, S-balls, and try to force his opponent to make mistakes. That is really hard for normal people like you and me. So how do we win in this investing game? We have to avoid the unforceful mistakes. We have to avoid the chance that we try to kill our opponent, try to make it win, try to win a point, but a lot of time we actually kill ourselves before our opponent make the mistake. So now we're gonna get into the second part of the video where we investigate how Warren Buffett has been winning this sports game in the long term. And do you guys actually know that Warren Buffett and Charlie Munger has a third partner who was in this investing game together up until 1975, and I'll tell you guys how this person was actually out of the game ever since. Just for people who doesn't know who Warren Buffett is, Warren Buffett has been starting investing in stocks since he's 11, and now he's 92 years old, so he has 81 years of experience in the stock market and has went through 15 recessions, including the one we just had. So we tend to think that he knows what he's talking about. And here are the rules that he stands by winning in the long term. First is he does not incur debts to invest. He doesn't borrow money. Second, he never held on to an outdated strategy or thinking while he's investing for his 81 years of career. So before 2012, he wasn't investing in the Apple stock. Why? Because he thinks that Apple stock's price to earning ratios is too high at 50. So he only wait until Apple's P ratio dropped down to 13, and that's when Apple's not really a tech startup anymore. It's a more established company, and that's when he started investing. And over the last 11 years, it has proven that this is a very successful investment. Another reason why Warren Buffett has been very successful for the last 81 years is because he has a long investing horizon. Not only he survived for a very long time, but also he looked at things in the long-term horizon. He never sabotaged his business reputation, and he knows that he will become a billionaire one day. Did you know that Warren Buffett's net worth of $80+ billion, 80% of that was made after the age of 65. What that means is that majority of the time that he's working hard only make him 20% of his net worth. But because he has a long investing horizon, he knows that eventually the wealth will snowball and will become the most wealthiest person in the world. Now that you know how Warren Buffett stays successful in the investing game, we're gonna introduce the secret person who has been a partner with Charlie Munger and Warren Buffett up to 1975, and we never heard about this person after that. And this person's name is Rick Gerwin. Rick Gerwin is as smart as Charlie Munger and Warren Buffett. But during the financial crisis of 1973 to 74, when the stock price dropped 70%, Rick thought that he's really smart and he went out and borrowed money on margin so that he can invest more and double down. What happened is that in 1975, the stock continued to go down so that he got margin call. So he needs to bring in more money or his position will all get sold at the worst price possible. So what did he do? He actually sold all his Berkshire Hathaway's A stock at $40 to Warren Buffett and Charlie Munger. And now that Berkshire Hathaway's A stock is valued at $470,000. So he sold it at 40, now it's at 470,000. You guys can do the math. And now that we understand the purpose of investing is actually a losing game and how do you not get strike out before your opponent makes a mistake, now we're going to introduce the concept of margin of safety, which is invented by the coach of Warren Buffett, Benjamin Graham. So the first concept of margin of safety is the price versus the value. If you can buy something for $100 and you can buy it for $90, if not $70, that extra buffer of $10 to $30 is the amount that you could lose but still break even. So that is the first main point of margin of safety. And another point that's very important in the margin of safety in today's world is that if you're going to invest in a stock, avoid a stock that has been hyped up by Reddit or the Wall Street bets, because these stocks has been highly discussed, the price has already been pushed up, most likely is probably overvalued and has a very high PE ratio, so avoid those stocks at all costs. The main concept of this video is how to lose less so that you can start thinking about winning more, but not win more and then when you lose and you lose big. You have to start looking at investing as a defense game, how not to make unforceful mistakes, and when you stop making those unforceful mistakes, then you can start thinking about attacking your opponents. Thanks for watching this video. If you find any value in this video, make sure you like this video and subscribe and put any question you have down in the comment section, and I'll see you on the next video. Say yay.